In this session, we'll look at inflation and deflation, which is purchasing power or the loss thereof, interest rates in terms of yield curves and the yield spread, what makes the dollar strong or weak and what effects that would have, and then we'll look at the business cycle, also mentioning gross domestic and gross national product. Inflation is a loss of purchasing power that occurs when consumer prices overall are rising. Basically, this is a much bigger concern for recent retirees than it is for people who are young and still in the workforce. Your salary tends to go up over time, but if you've just thrown the switch and you're now in retirement, you're going to be living on maybe a pension or an annuity or fixed income products like bonds. So you're going to get this fixed income, but if prices are rising, you're not going to be able to keep up. So the price of food and energy and clothing and everything is rising. That's inflation, a loss of purchasing power. This usually occurs when the economy is expanding rapidly. When the economy slows down, goes into a slump, we might see deflation, the opposite. Suddenly overall prices are dropping and temporarily we see an increase in purchasing power. Although that's really not good news. The economy is stalling, people are going to be laid off and they're not going to be able to buy anything because they don't have a paycheck. So what would cause inflation? As you see, high demand versus supply. Similar to if you go to the ballpark, the supply is limited of whatever it is, beer, hot dogs, and Pepsi, and therefore the prices go through the roof. Weak demand versus supply, whenever we have too much to sell off, the prices are going to drop. That can lead to deflation. Interest rates, for a lot of people, at this point, they've only experienced them in terms of what they have to pay. Now, the lower the interest rate, the better for a student loan or for a credit card offer, certainly for a mortgage. The difference between 5% and 8% could often be the difference of whether you can get the house or not. But when you become an investor and you start putting money into annuities or bonds or even just go to the bank and open up a savings account or get a CD, when you're receiving interest rates, you obviously want to receive the highest rates possible. The yield curve. Why are we looking at treasuries? Well, we don't want any default risk here. We just want to look at the difference in yields as you go out in time. We expect to get higher yields if we buy a 2 or a 5 or a 10-year security compared to a short-term T-bill, and we usually can get a higher yield on a 30-year T-bond than any of that, but it doesn't always work that way. In a normal situation, this is probably what happens 2/3 of the time. Maybe we're looking at T-bills that yield about 1.5 and T-notes that yield at least 2. And then maybe out here at the 10-year it jumps up to 3. And then you get about 3.5 if you're buying a T-bond. That's a positive yield curve. As we go out in time for the maturities, we receive a higher yield because we're taking on more inflation risk. On a 30-year T-bond, that's 60 payments. Who knows what inflation will be doing as I get them. For a 4-week or a 3-month T-bill, I'm obviously not taking on any inflation risk. And that's why in some other applications we talk about the riskless rate of return, which is the rate on the 3-month T-bill. There's no default risk on any of these, and on the 3-month T-bill there's really no inflation risk either. So in a positive yield curve, the yields go up as we go out in time. Sometimes we see an inverted yield curve. For some reason, we're getting higher yields on the short-term securities. Usually a temporary situation, usually happens after the Federal Reserve Board has been raising interest rates dramatically for a long time, but they're about to stop doing that. Here it's the opposite. Same maturities. How much more yield can I get if I'll take on some risk? The difference between treasuries and junk, or the difference between investment grade and junk. I think I usually see it the first way. And so the test might talk about the risk premium. Well, that's just the higher yield you could get on the junk bond. For the short term, there's a 1.5% risk premium. You might say, is that really worth it? Here, 1.6, and here's a pretty big risk premium. I can get 3.5 percentage points higher if I buy junk bonds as opposed to treasury bonds. When that yield spread widens, that's considered a bad sign for the economy. People are nervous. When it's narrow, that means that consumers or investors are more confident. They're not worried about getting their money back. They don't demand a much higher risk premium. So whether it's treasury versus high yield or investment grade versus high yield, how much more yield can I get if I take on some credit risk? And then is that worth doing? And see, that's what often happens when the Fed gets involved and they keep interest rates down for a long time. Senior citizens who really shouldn't do it start putting their money into junk bonds because it's the only place they can get a decent yield. Well, that might be taking on way too much risk for just a few more percentage points. The strength of the dollar. Why would the dollar strengthen or weaken? Well, if you can just park your money into U.S. Treasuries, you're not taking on any risk. And if yields here in the U.S. are higher than anywhere else, that's going to increase the demand for investors to do that. And the demand for those dollar-denominated investments will increase the strength of the dollar. And then if we have the opposite situation, investors can get higher yields elsewhere. They're going to pull their money out, and then the demand for the U.S. dollar will drop. The dollar will then weaken. But neither one is necessarily good or bad. And that's where tricky questions can come in. Strong dollar just sounds good, and weak dollar sounds bad. But when we're doing economics, you don't want to jump to conclusions like that. Turns out a strong dollar is no good if you're trying to export from the U.S. If we have a strong dollar, that means in this example, the Japanese can't buy our suddenly expensive goods. So that would hurt our exports, a strong dollar. So it sounds good, oh, the dollar's strong, but it's going to hurt exports. Just like a weak dollar sounds bad, but in fact it would make our exported goods to Japan much cheaper. They would be able to buy more. It should increase exports, all things being equal. Alright, so a strong dollar actually is bad if you're a farmer or another exporter trying to sell overseas. A weak dollar would help you in terms of selling more to the overseas market. Sometimes called the boom and bust cycle or the business cycle. What are the phases? In my experience, I haven't seen a lot of questions on this, but it's always on the outline, so we have to cover it. When we see good news back to back, the gross domestic product is growing at 3 or 4%, we're in a period of expansion. People are working, businesses are reporting higher profits, consumer confidence is up. When that levels off, we're at the peak. And then when we start to see people losing their job, losing their confidence, we're in the period known as either the contraction or an economic decline. When the bad news flattens out, we're in the trough. And then when we see a pickup in the economic data, we either are in another expansion or we call it the recovery. What's the difference between GN and GDP? Well, the words national versus domestic. If it's happening in the U.S., it's gross domestic product. We don't care who's doing the labor. Gross national product is where we're tracking only the productivity of Americans, even if they're stationed overseas. So, for example, U.S. workers stationed in Canada working for an American company, that's part of our GNP, they're Americans, but it's happening in Canada, so it's not part of our GDP. Over here, Japanese nationals stationed temporarily in Kentucky, they're working for a Japanese company. Their productivity is happening domestically, but they're Japanese nationals, so it's part of their GNP, not ours. And that's why we're breaking this up into just these lessons. So inflation, a loss of purchasing power, it's more critical when you've just retired, you've got a lot of years up ahead, but you're going to be living on fixed income, as opposed to being a younger worker still in the workplace. The yield curve, how much do yields go up over time? And the yield spread, how much more yield could I get on a junk bond? Strong dollar versus weak dollar, and surprisingly the strong dollar hurts our exports, whereas the weak dollar helps. And then the business cycle with its phases, and of course you could see a question differentiating GDP versus GNP.